And we are live, ladies and gentlemen. Welcome back to Deal Flow Live. This is the show where we talk all things business deal making. We talk about buying businesses, selling businesses, everything in between, all the little nuances, everything you need to be thinking about if you are thinking about buying or selling a business, or even maybe becoming an intermediary, maybe getting paid to help facilitate the buying or selling of businesses. And today we're covering something called SDE, or seller's discretionary earnings. And this episode is probably long overdue because this is a concept that if you're just getting into deal making, or maybe even if you've been in it for a little while, is very, very important. And if you miss this concept when you're working on small business deals, it is going to drastically change the economics of your deal. Knowing the SDE of a business can be the difference between knowing like what price you should be paying for it or not, and not understanding what the SDE is in some cases can dramatically change what kind of cash flow you're receiving from the business. Ryan, it was your idea to cover this today. I thought it was such a good call on your part because it's not something we've really done a super deep dive on. We've mentioned it many, many times on episodes in the past, but today we're really diving into it deep, kind of explaining everything you need to know about it from either the buying or the selling perspective and how you should be thinking about it.
Yeah, it's one of those ones where I feel like we talk about it every week, but we don't really dive into it because we say things like, oh, your seller takes home 120,000. That's what we see the net listed as, but sometimes, the net is not necessarily true, or the seller's discretionary earnings are just that, discretionary.
And the net
Um,
profit is what you mean, right?
and as we've experienced, and as you're currently going through with a number of your clients, a lot of times when people are trying to figure out how they can make their business look better, it's about making that SDE larger, and that means untangling a lot of your personal stuff that was in the business, untangling it and putting that number back into the SDE.
That's right. So I think, the best way, me personally at least, the best way for me to ever like learn things or understand things is always visually. It's really hard to kind of put like an actual thought around something like SDE because it's such an abstract concept. So Ryan and I figured the best way for us to go over it today is going to be just to actually work through some examples of how you would calculate SDE, how you would actually literally come up with it and understand it. And I think by the end of this episode, I think you're going to have a lot better understanding of it. Ryan, like when we're talking about SDE, could you give us a little bit of an explanation of it to start? Just kind of like I guess, a definition of what it is and how it's come up with?
Yeah, so SDE in itself is seller's discretionary earnings. That is what the seller is in theory saying that they take home. That is what's left at the end of the day when all the bills are paid, when everything's put in. And that number is essentially what you would know that's pre-tax too. So essentially, it's what your gross check would be at the end of a full year, theoretically. And a lot of times that is what a business, that's the first thing people look at is what's the take home? What's the take home against the effort? So a lot of times with people, we see that they're kind of at a point where it's going really well and things are moving, but they've tied up a phone, two cars, a vacation home, a boat is into their SDE. So let's say they do a mill. Let's say they're doing a flat million sales confirmed, but the seller SDE is $100,000. Now, either they have terrible financials or they've wrapped up so much of their life into the business that there's like $75,000 a year being siphoned into their personal stuff, which again is still good for them, bad for the resale value. So a seller's discretionary earnings is essentially the paycheck that you would get cut pre-tax at the end of a year.
That's exactly right. And the reason it's so important is the reason people buy businesses or own businesses in the first place is to make money, right? What else is it about other than having freedom and making money? If you're buying a business, you are buying it for its ability to make cash flow that you can take home in your bank account. So the SDE is the literal cash flow that will be available to you as an owner. So I'm going to share something here for those of you who are actually watching, which is kind of a financial calculator. This is something that we use in one of my businesses, and it's called an add back. We call this an add back template. What you're looking at is basically a profit and loss statement, but it's going to look, for those of you who are familiar with profit and loss statements, it's going to look a little bit upside down, and that's for a reason. If you see actually, let me scroll up here a little bit. If you see the kind of the top here, the net profit up here is actually at the top. And then all of the line items are throughout here like they would typically be. Then you see at the bottom, we actually have an adjusted version of net income. So the reason for that is when we think about a traditional profit and loss statement, the net income is at the very bottom line. But you have these different line items that are being taken out as expenses for you to get to that net profit at the bottom. We actually have to add certain ones back in to arrive at the cash that is available to a new owner. The biggest reason for that is when a business changes hands, when it goes from one owner to another owner, the new owner is not necessarily going to have all the same expenses. There are things that are legitimate things that you can write off for tax purposes that are allowed with the IRS, but that are not essential to the operations of the business. And that's the key question here. So when we think about the expenses that you need to look at to understand what a business is going to take to run, we only think about essential expenses, things that are essential for the business to keep running. So you might be writing off a vehicle that you use for business to drive to and from the business, but that vehicle is not essential to the operations of the business. So if a previous owner is writing that off, maybe let's say they're paying 20 grand a year for this vehicle in lease payments or something, and they're driving to and from the office. Maybe it's an expensive vehicle that they're paying for, and they're writing it off so that they pay less in taxes at the end of the year. That's allowed as long as they're using it for business. However, it is not essential to the operations of the business. So we would add that back to the net profit to see how much cash will actually be available to a new owner if they choose not to have an expensive vehicle in the line items of their business. So let's go through kind of an example here. We'll look at just like 1 year at a time. Let's pretend, for sake of the example, that we're just looking at the year 2024 here. And let's say that this is a business that had, let's make it a little bit of a bigger, small business. Let's say it had $1 million in net income. And let's say that there was 200 grand in a PPP loan. And so you add that back in. Now we see the EBITDA, or the earnings before interest, taxes, depreciation, and amortization, was $1 million. So some of these things don't factor in, like the loan forgiveness income and things like that. But let's say there was 50 grand in owner salary and insurance. Let's say there was another 5 grand in payroll tax for that owner. And let's say, for sake of argument, that this is an owner paying themselves as a previous owner, but they are an absentee owner and they're really just paying themselves so that they can show a nice W-2 income, but they are not essential to the operations of the business in the case of this example. So we're adding these back because they're not essential payments. Let's say they also had a $20,000 a year lease of a vehicle that they were making payments to. And let's say another 5 grand in other expenses for vehicle fuel and auto repair. Let's say they've got health insurance that they're paying $300 a month for. say it's another $3,600. And let's say they're paying another $50 a month in life insurance, $600. And let's say they're paying $150 a month for their cell phone. As you can see, these things start to add up. It's another $1,800. Let's say they like to really use the business as a little bit of a piggy bank, and they're writing off a lot of meals. Let's say they're taking friends and clients and neighbors and anyone that'll listen to their latest business idea out to lunch, and they're keeping the receipts. They're writing it off. These some of these rules are changing, so don't listen, IRS. We're not doing things like this.
No, never.
Some of these rules are changing. But let's say, in the old days before the IRS started cracking down on this, let's say they're spending about $500 a month on taking people out to lunches and dinners and things like that. Another $6,000. Oops. And let's say they're also doing some traveling. Let's say, they spot an opportunity to go to a conference in another state every once in a while. And you know what? They're doing a little bit of a frolic when they go on that trip. They're maybe going on some excursions and things like that. So maybe they stay a few extra days in the hotel that they get every once in a while. And they're racking up a lot of travel. I mean, they're making $1 million a year in profit. So who's going to argue with them? Let's say they're spending $2,000 a month on travel. It's another $24,000 a year. Let's say they're also contributing to a retirement plan, and they're able to write that off as it pertains to the business. Let's say they're spending $6,000 a year that they're putting into a Roth IRA. And let's say that they also have some personal, legal, accounting, tax services stuff that they're running through the business. They're running it as a business expense every time that they have an accountant draw up things for their bookkeeping. Maybe they've got an outsourced firm that's doing all their bookkeeping. And let's say they've got a few different businesses that are going on, but they're writing it all off on this one business. And let's say maybe it's $1,000 a month that they're paying an extra personal bookkeeping to make sure everything's squared and ready for their taxes. And maybe another $2,000 for the complications of filing their taxes, right? So that's $1,000 a month, $12,000, and plus another $14,000. Let's say they also had, a couple legal things that happened. And let's say altogether in extra legal and tax and accounting stuff, let's say they spent $30,000. And, let's say there's a couple other little random things, a couple little things that they bought just for some research and development that are extra owner benefits that weren't really essential to the business, but were loosely related to it, and that they could make a legitimate claim to write off, say another $15,000 and kind of random miscellaneous stuff like that. Now, let's say they also have this deadbeat son who shows up to the business and, clocks in and just kind of hangs out and collects a paycheck. But, what else is this guy going to do? He's a deadbeat, We've all seen businesses where there's family members that are on the payroll that are doing things like that. There's also family members that contribute legitimately to businesses, but we do see this happen. And, what are you going to do? The business is kicking off over $1 million a year in cash flow. We're going to let little Johnny have a salary too. Let's say he's collecting $40,000 a year just to pay his bills. He's not really doing a lot. Let's say there's another $10,000 in just miscellaneous personal expenses. And let's say this owner also owns the office that this business is being operated out of. This is one that's common, but often forgotten about. So let's say you own this business, right? You also own the office that it's in. What happens a lot of times is the owner does not charge themselves fair market value rent. A lot of times they charge the business rather less than it costs for fair market value rent. But also sometimes they charge more. Really just depends. But let's say you need to do an adjustment for fair market value rent, and you in reality, let's say you undercharged yourself by 30 grand for the year. So you need to add that back in. Let's say maybe you're a member of a couple social clubs and things like that. This owner is making a lot of money. He wants to go to the local country club. He plays a lot of golf with his buddies and things like that. And it's a business expense. He's having business conversations, but it's not going to be essential to a new owner. Let's say he's got about another 24 grand or 2 grand a month in different memberships and things like that. Because this guy makes money, he can do it. And also, let's say he's a charitable guy. This guy's got some causes that he cares about, and he's fully aware that if he contributes to certain charities from the business, he can write it off on his taxes. Let's say he went kind of crazy this year. Let's say he put 80 grand towards a charity. And, let's say there was a piece of machinery. Let's say this is like a blue collar service business, and this owner decided, I'm going to buy this new machine that is going to allow us to do a service that we weren't doing before. And this thing is going to last 30 years. It's really not going to depreciate very quickly. It's going to be able to carry this business for a long time. And so this is going to be a one-time expense that, the next owner might not even recur. They might not even have to think about buying another one of these machines the whole time they run the business, but they're going to be able to benefit from it. Let's say it was $100,000 machine one time. So that's a non-recurring one-time extraordinary expense. And let's say maybe just another 40 grand in miscellaneous expenses that don't necessarily fit squarely into some of these categories. And we'll just skip this one. But as you can see, we're at the bottom here now. We started with $1 million a year in EBITDA or net profit. So on the surface level, if you were only looking at the tax returns of this business, it looks like it makes $1 million a year. Great business, right? You might be willing to pay, I don't know, $3-4 million for this business, depending on the industry it's in. Maybe less, maybe even more, depending on the industry, depending on a lot of what's going on in the business. But by the time we get down to doing all of these adjustments, as you can see, there's another $491,000 a year that wasn't being accounted for. So in reality, if you were the new owner of this business, you might be able to take home almost another $500,000 in cash flow if you're not being as gratuitous with all of these expenses. So that's something you have to really factor into your decision. You might be willing to pay a whole nother $1 million in purchase price or something like that. Maybe even $1.5 million or a couple million, depending on the business, because it's creating a lot more cash flow per year than it looked like it was on the surface level. So this, ladies and gentlemen, this is why SDE is so important to understand, because for small businesses like this, Ryan and I call these lifestyle businesses. These are businesses that, are owned by an owner that's often very active in the business, or even if they run it absentee, they're very active on the P&L, and they have a lot of say in what kind of expenses come in and out of the business, even if they're not essential to the operations. This is very, very common with businesses making, I would even say, less than $10 million a year in profit, which is like 99.9% of businesses. So when we look at this, it's so important to understand this, because you need to understand, as someone who's either selling your business, how much it's actually making and worth. You need to do an exercise like this, or have your CPA or accountant do one. Or if you're buying a business, you need to understand what it's like under the hood, and you cannot just take it at face value based on tax returns, especially if you're just, maybe you're just buying a friend's business and there's no business broker involved. There's no intermediary of any kind involved to explain these things to you and to walk you through like the buying and selling math of a business. These are things that you really need to understand, and using a pretty simple tool like this, you can do so. Quick little plug, but I do have some YouTube videos out there where I explain valuation and stuff like this. And some of those videos, you can actually go in the description of them and just download this for yourself so you can use it. But Ryan, let's talk about this a little bit. What are your thoughts after going through this pretty extreme example? It's fairly extreme, but it's also not that extreme.
I was gonna say, it's not so much extreme as it is we're just using bigger numbers to describe what the concept is that we're trying to convey. And I think if it's not, it seems almost gratuitous. It can look like they're just making stuff up, and like, yes, perhaps the owner benefits are 15,000, maybe they're $5,000, but I think if people really took stock of what they've tied up in their business, which, by the way, there's nothing wrong with, plenty of people do it. However, when you're focused on getting your business prepared to sell in the next year or two, one thing that, like we said, adjusted net income going from 1 to 1.4, you can really command a larger multiple. You can say, I want that extra 0.5. You can go from 2.5 to a 3. You can go from 3 to 3.5 theoretically, because the value of the business has increased by $500,000 and you did nothing but just untie your life from it. And on another note, maybe while you're untying it, you find out that, all right, based on how my life is going, because when people usually sell their businesses, they're not looking to do more work. It's a good idea of what you need to get rid of and how to tighten your budget up, because, as we've talked to a number of CPAs, not every CPA understands how to sell a business. Not every CPA does that frequently. It's a pretty rare thing for them at this point in time. But, when they're trying to get your finances in order and they see that your income is $1 million and you were actually spending $1.5 million theoretically, and they didn't account for that, well, now the whole thing is off. So there's a layer to it beyond just the sale of the business. There's the personal life of it with the business owner beyond that. I think we need to really be talking about as well, and why we're doing this.
It's a great point. Yeah, this can, even if you're not thinking about buying or selling a business and you just are an existing business owner, this is an exercise that I would recommend doing yearly after you get your tax statement, after you file taxes. I would recommend doing this just to get an idea of like how much could be coming into, like how much profit you could be taking home. Because in this not so extreme example, but fairly dramatic example, this person could be, there's so much they could be doing with that extra $490,000 a year. I mean, imagine you invest that in something making a decent return every year. All of a sudden, you could be doing dramatically different things in your business. And obviously, there's an argument to say that some of the examples we went through, like, is them reinvesting in the business. We're not blind to that fact, but it's just a good exercise to be able to see, what did I actually spend my money on? And a lot of times, that like the owners of businesses don't take enough time on that. They'll just get their tax statement back and be like, how low can we get the number? Like, Mr. CPA, make the number as low as possible. What can we do here? Which is all fine and dandy as long as you're playing by the rules and not being stupid. But this is really not often thought about. Another thing that you said in there, Ryan, that I think is so key and so important is that a lot of CPAs don't really quite get this, unfortunately, and it's
not their fault.
It's not their fault. The truth is a lot of them just haven't been through a business transaction before. We see it all the time where, like, I have a lot of CPAs that will come to me, or accountants that will come to me, and they are used to working with small businesses. And all of a sudden, after maybe 5, 10, 20 or more years, they just say, this is my first time helping someone sell their business. And they're asking me these questions that none of my clients have ever asked me before. And I don't really understand how this stuff works. This is how it works. They spend all of their time, like if they're good at what they do and they're trying to serve their clients, and they're working with mostly small business clients, they spend all of their time trying to make sure that their clients are legally paying as little taxes as possible. We all know this. So to think the opposite way and try to make the business look like it's making as much as possible is often completely foreign and strange to your CPA. So if you're someone who's in this position, show them this video, have them walk through this. If they really are, enthusiastic about taxes and about P&Ls and line items, they're actually probably going to really enjoy learning about this kind of thing. But walk them through something like this. Send them this video because they need to understand this. And maybe you're like a lot of clients I have and a lot of business owners I know personally who, you don't want to even think about your profit and loss statement. You just want to let the bean counters handle it. And that's okay. If you have some great bean counters handling it for you, send them this video and have them kind of learn the ropes of how this stuff works. Because if you are ever, let's say, making an acquisition to expand your business, or you're selling your business, or you're thinking about it, just wanting to know how much you could and should get for it, you need to understand it accurately. And if you're selling a business, I can't emphasize this enough. If you're selling a business and someone very experienced is buying your business, they're not going to overpay if you don't tell them how much it's worth. You got to understand this stuff and understand how to arrive at this stuff so that you can represent your value accurately. So go through this exercise. You saw Ryan and I walk through it in less than 20 minutes. It doesn't take that long. You just have to go back through your tax statement and come up with it.
Yeah, it's a small thing. It seems stupid, but at the end of the day, it's a difference maker for a lot of business owners getting to that number that they want. Sometimes it was there the whole time. They just didn't have it properly laid out. And that's fine. Like when you're in the middle of running your business, when you're still there active in it, like, yeah, get that tax bill as low as possible. Figure out the legal ways to drive it down. Like, that's fine. But when you're getting to that sale, it's, there's a bit of discomfort you're going to go through untangling the mess. If theoretically, if it wasn't done properly, or you don't know how it all works. So if you change CPAs multiple times, sometimes that new one wasn't there where the old one did it, and they have to do a whole nother process to untangle why your taxes are filed the way they are and why things are marked like they are.
That's right. Any other notes that you would leave someone kind of thinking, I guess, like final note for someone on the buy side thinking about this, final note for someone on the sell side thinking about this, Ryan?
I think if you're on the buy side, you always have to take the SDE with a grain of salt, because you have to wonder what else is tied up in the business. If it's really what it is, what are the taxes, are there other stuff beyond the SDE, which is something we didn't even touch on, that there's stuff past the SDE. Even if the SDE is what we call in this situation clean, there's also sometimes some stuff after it. So there's after stuff that needs to come out of the SDE that isn't marked on the price tag, essentially. So you always have to wonder about that. And the question that we always pose from our friend Grant, who's been on the show, is that an amount of money that you would be willing to get up out of bed and work for every day? And if you can say the amount of work that I would be doing and the amount of money I'd be bringing in is not worth it, well, then you have your answer. And for sellers, I would say start early, start often. The cleaner you can get, if at some point in the next, let's say 5 years, if you're feeling like you want to do it in the next 5 years, start the untanglement now. Start taking little things back onto your plate, adjusting everything, eating the taxes a little bit more, but basically making it as clean as possible for your potential buyer. And also, if you're thinking about selling in the future or you're looking to buy, we do have resources at Scale for Sale here where we help people figure out where they're at and where they're going. And like we said, half the time, the people who are buying, we have a network of sellers who we can connect them with and have really good transactional documents on, and makes it a seamless process. And for our sellers, everybody wants to sell when they come to us, and I'd say half of them end up keeping it because we fix a lot of problems. We end up staying on with them and continuing to help them grow their business, and they find that fun again. That is at the core of why they started it. So we do a lot of stuff for a lot of people, and at the end of the day, it's just a lot of fun for everybody. So whether you're selling, trying to clean up, or looking to purchase, let us know. We'd love to help you, and we'd love to answer your questions.
That's right. If you are finding yourself in that position, you can just go to scaleforsale.com, check out some of what we do, who we help, and what kind of stuff we work on, and we'd be happy to have a conversation with you. We make it pretty easy to understand, what we're about on there, and what we can do with you and whatever your goal is. And if you're just someone who's interested in continuing to learn about this stuff, first off, we're happy you're here. Thanks for tuning in. Thanks for being part of the show. Ryan and I really enjoy talking about this stuff, and it's nice to be able to share it with people who are also enthusiastic about this stuff. And so you can tune in every Tuesday night, right around 6 p.m. Eastern Standard Time, for future episodes of Deal Flow Live, where we cover concepts like this, like SDE, like how you figure it out, what it is, why it's important, and anything related to the buying and selling of businesses. We will see you on the next one. And Ryan, where can they find us?
Find my personal on LinkedIn, just Ryan Santo on LinkedIn. And Brody is brodyvincent.io on Instagram. And of course, you can find us both at Scale for Sale and also Brody Vincent on YouTube as well for all those videos and the free templates down below in the descriptions.
All previous episodes of Deal Flow Live can be found on my YouTube or my LinkedIn or Facebook, I believe, even Twitch now. So you can find previous episodes of concepts Ryan and I have covered there if you liked this. But until the next time, we will see you next week. And thanks for tuning in.
See ya.